First of all, most profit and loss statements are multiple page documents, and they are usually stapled together on the corners or the ends. What we've done is really taken a P&L statement, shortened it up, and put it on one piece of paper so you can examine it. This is strictly a classroom exercise. However, this is a compilation of a series of distributors in the lab glass business from a session I did several years ago for Corning Glass. They sell laboratory glass like beakers, whatever. And this business is a distributorship for selling those beakers and pipettes and Petri dishes and etc. What I want you to do is look to the left and notice that in this hypothetical distributor, you see a series of the alphabet, A through L. That is your cover sheet on a P&L statement. It has a very famous line on it, the bottom line, which is line L, and we'll get back and examine how you got to there in a minute. But after that cover sheet, you have to go into what's called a schedule of operating expenses. So page 1 of the schedule of operating expenses would be the selling expenses page, which is lines 1 through 4. And of course, this is very simply done for a classroom example. And then the next page is delivery and warehouse expenses, page 5 through 9. And then, of course, it's the general and administrative expenses, page 5 through 18. Now, I want to take you through each one of the pages, but I want to make some recommendations to you. Whenever you analyze a P&L statement, the very first thing you need to do is take the staple out, spread those sheets out, put a page number on each one of them, because so many terms in accounting are similar that you might be talking to somebody, arguing or debating something, and you're talking about two different lines in the P&L statement. It's not uncommon at all. So one of the dumb things I like to do, I sit on a few boards of directors, the very first thing I like to do is take the damn thing apart, page number, and then out on the left, I number each line. So I say to people, like, example, would you go to delivery and warehouse expenses, line 5, delivery salaries? And now we're all in the same place. So let's kind of do that, and we'll start with the top. In this particular business, since it is not a manufacturer, a distributor has to arrive at its gross profit through a calculation of purchases and reselling. For example, how a distributor makes its money, Nancy, is the same business you and I were in. We bought those risks from a manufacturer, marked them up, and sold them. So let's look at that. The very first thing we were concerned about is our sale. Now, just so you didn't have to use a calculator and everything, we've converted this to $1,000, 100%. So if you look at it, the gross sales, $100,000, and therefore it's 100%. Now that sometimes is characterized as gross revenue, and that might mean that the revenue stream has several inputs. For example, we divide our business, persuasive communication, between the open seminar business, which you're in, i.e. 7, 8 companies, dedicated meetings, a DeSoto meeting only. We also have some other things that we do that are different revenue sources. So we might have 3 or 4 lines, and then it equals a line called gross revenue. So this company has only one thing. They sell this lab glass, so they have gross sales. Now, they took an inventory on line B on a certain date, and it's reflected there as $13,000. Then they went through purchases on line C, took the transportation into effect, and had a total available for sale on line E, took the inventory on line F, and that gives you, for that accounting period, and we can call this a month, a week, a quarter, whatever you want, line G, cost of goods sold. Now, how a manufacturer gets the cost of goods sold is they take their direct labor cost, their direct material cost, subtract that from their gross sales, and that's their gross profit. So let's take a look at what we're going to do. We're going to take our cost of goods sold, which is line G, and subtract it from line A, and come up with our gross profit on sales, which in this business is 38%. Now, from 38%, we must now subtract the operating expense, and that's lines 1 through 18. I might warn you that 2 of your cases are going to be locked up in this P&L statement. So if I'm not being clear, make sure I am. So let's take a look at what line I is. When you take total operating expense, see that asterisk of 35% or $35,000? When you subtract line I from H, you have the net operating profit before taxes. Well, line I is the result of lines 1 through 18, so let's take a look at it. Sales salaries, line 1, under selling expense, 12%. Go to the right and notice that we've added fixed and variable. That's the next suggestion I'd like to give you. If you're truly going to be able to analyze a P&L statement, you have to understand what's fixed and what's variable, because variable you can have an immediate effect on. Fixed is in effect those numbers that do not change within an accounting period relative to volume. So tell me something. If it's $12,000, what is that fixed part? What does that mean?
Would be the car.
No, that's a salary.
Salary.
Yeah, Harley's got it. It's a base guaranteed salary. Now, the 7% in this particular accounting period is what? Commission. Okay, good. Look at travel and entertainment and notice something. It's in the variable column. That's a management decision. You could also make that a fixed number. For example, in our business, we take it fixed. We do a budget ahead of time. Mark and I and everyone in the company has a budget for travel and entertainment. What I say to my employees is if business gets real tough, I may come in and change that fixed number in the next accounting period, or I may not. What this company's saying is when business is bad, you'll spend less money. When business is good, you can spend more money. I don't know if that's a good, bad, or indifferent approach. It just doesn't fit my business. Just so you understand what caused it. Look at sales promotions. 1% fixed. Why do you think this is fixed?
It's a budgeted item.
It's a budget item, also it's contracted for. It's, for example, in some businesses you buy space in the yellow pages, you owe it. Doesn't matter whether it worked or not, or how business is, you get a bill for it. So it's a contracted budgeted item. That gives us line 4, which is total selling expense, which is 14%. Now let's go to delivery and warehouse expense. It says delivery salaries are 1%, but they're in the variable column. How come? Yeah, they ship everything UPS. This is our version of Clark, Nancy.
Okay. Can be fixed if you have your own truck with your own guy.
It would be fixed.
Base salary, and that will be fixed.
Then it would be fixed. So just reading this P&L statement now, you already know some things about them. They don't own their own truck. They probably use some kind of common carrier. In this case, it's UPS. All right, let's go to the next one. It says warehouse services, 2% fixed.
Shipping clerk.
Yeah.
Okay.
But that's going to be.
That's the work. The next one, item 7, is the couple employees. It's warehouse salary, and that's variable. Now, what that really means is something like this, and I happen to know this business, they call in some geriatrics or part-time people when they get busy, and they pick the stuff and package. They're not busy, they don't call them in. So it's strictly a variable labor. I was in a Firestone tire manufacturing plant in Detroit a few years ago, and every 4 hours the computer pukes out a number, says how many people can be on that line. And they got to deal with the union. Every 4 hours they can go out and lay off or add labor. And the labor pool sits around. That's how, now not all businesses do that, but Firestone is a very sophisticated business making tires. Comment or question, Harvey?
Question. Item 6 is their own labor. That's also labor.
That's
the warehouse.
It's probably the one warehouse manager or something like that. I really don't remember, but it is fixed. Okay, now let's take a look at general administrative officers' salaries. Fixed. That's salary. Telephone and supplies. Budgeted item. Fixed. Insurance fixed. Payroll taxes fixed. Rent fixed. Straight through. So if you look at line 16, you'll see a TFC. That's the total fixed cost is 24% in this business. The total variable cost 11% in this business. When you add those up, you wind up with the total operating expense of 35%. Now take that back up to the top of the P&L statement, which is line I, subtract that from the gross profit and sales, and that leaves you 3% net operating profit. Question, is this a healthy business? Truth is, you don't know for a couple of reasons. We don't know if this is an accounting period. If this is a week, it might be pretty good. If this is, the other thing, we don't know what the investment in the business is, because it has to be a calculation return on investment. Now let's just take and dip our toe into a balance sheet for a second. Nancy, when you and I went into business, we didn't tell these guys how much we invested. But you had $5,000 socked away, and so did I. Okay, so what, on our balance sheet, not on our P&L statement, we had an investment in our business, $10,000. Your money, my money. What we did with that money is we invested it in inventory. So we put $10,000 in inventory. And because of our smart selling, we sold what we had. We got rid of the dogs quick. We didn't buy badly. We turned that inventory 10 times. So we have $100,000 sales, which matches this P&L statement. This is us, see? Now, let's go through the whole machination, even past the tax, and what we wind up with is $2,000 of profit. We've got our salaries and all the rest of it. Now, to ask you the question of, is that a good business? The return on investment. What's the return of that 2 against the 10 that Nancy and I have invested?
20%.
That's not too bad, is it?
It's bad because you guys aren't paying yourself.
We're not paying ourselves?
Yeah,
There's-
it's really bad because
There's office salaries in there.
Well, originally your business said you.
No, I'm saying,
Okay,
use this
you-
P&L statement. There's officer salaries in there. That's not a bad return on investment for money, is it?
No.
Okay, now, there's another business across town. Tom, you and Robin own this business. And you two guys, both born with a silver spoon. You got too much money. And what you do is put $25,000 a piece in, so you have $50,000. And because of bad buying, you're a little bit lazy, you only turn that inventory twice. You have the same $100,000 P&L statement. The bank looks at it, and you wind up with $2,000 of profit, and the bank says to me, oh, Tom and Robin are doing just as well as you and Nancy. No way. Because their return on investment is going to be somewhere down here. They can do better in a passbook. Now, let me just give you some clues. What I'm about to show you does not just happen in small corporations. It happens in big corporations. It just shows up in different ways. Every once in a while, I get called in on a consulting assignment. A business that I look at says the problem sales, and I look at it and they've had record sales, but they're losing money. So this little business will say to me, well, I used to make money, but I'm not making money anymore. I want to show you how to do an audit. First thing you do in an audit is get your P&L statement out. Second thing you do is get the checkbook out and all the petty cash chits, and you make sure that the checkbook is tied to every expense category. So I start looking down this list here in selling expense. The first thing I want to do is look at this travel and entertainment expense budget. And I noticed something. We'll pretend this is your business for a minute, Susan. You have a East Bank Club membership in travel and entertainment. So I look at, that's a health club in the area. So I look at the chits. It turns out that everything you sign is for your own meals and your exercise and your tennis lessons and all the rest of it. Now I look at you and I say, I'm not an IRS guy, but I have to tell you something. You think you're only making $5,000 down here? Truth of the matter is I have to take your entire East Bank Club and multiply it by 130%. That's the tax bracket you're in, 30%. That's how much money you would have had to make if you took it out as salary and paid it. So we're going to add that. I said, okay, you're doing a little better than you thought you did. Now let's take a look at another one. See where it says sales promotion? I find out that you keep a sailboat in Burnham Harbor and you pay for the slip through the company. And that's $4,000 a year. I'm going to take that $4,000 and multiply it by 130% and add it to your salary account, just between us girls, all right? Now let's take a look down the line. You see item 8? Item 8 is one of the wonderful items in all audits. When I go through item 8, I find out that you deal with a company called the French Dry Cleaning Service. who picks up those beautiful blouses and suits once a week, dry cleans them, and delivers them to your house, not to the plant. And you ran that through the business. So I take your $1,000 worth of cleaning last year and multiply it by 130%, put in your salary account. Do I need to finish? So an awful lot of what goes on in a business is lost this way in the way of perk. You say, well, that's just small businesses. No way. I got picked up 3 months ago by a client of mine in a bloody Lear jet and flown to a private airport right near their corporate office. And then they took me in a helicopter to a helipad.
This is for real.
This is for real. It goes on all the time. Many of your companies have airplanes and all those are, and corporate apartments in New York and all San Francisco, and those are nice, but they are also perks. And they are lost in here as expenses. So that you want to really know how a business does, you need the balance sheet to do an ROI, and you need a careful audit to see where the revenue streams for you are going.